leverage, because that's more indicative of a trend. If a bank is growing revenue faster than they're growing expenses over a long time frame, right now they don't have much in earnings, but the growth outlook is really good, the bank should naturally move up to a higher valuation over time.
Do you ever look at like revenues divided by the number of employees to see?
Yeah, revenue per FTE is. We look at that occasionally.
Mm-hmm.
It's pretty standard across the industry, and it depends on what a bank is doing. Like if it has more, like a mortgage business that has a big back office, wealth management that has a big back office expense you have to incur. So there's a lot of different factors. I'd say the few places where it stands out is if a bank has a lot of international exposure, which is not many of our banks. One in particular comes to mind that has a lot of exposure in Venezuela, of all places. They have a lot of back office people related to BSA, Bank Secrecy Act, and then AML, anti-money laundering, and that's one of the banks that stands out on kind of that scale. So it's pretty clean cut across the board, though.
Okay.
And just to get an idea of kind of where most banks operate, I put a graph in there on the right. This is all public banks across the United States, kind of the percentile rank of how efficiently banks are being run. What's interesting is I looked at this from 2 years ago, so pulled 2016, before we got tax reform, before we got Fed rate hikes really in effect, and you would have seen a static shift in each of these, about 5-10% of efficiency. So banks from tax reform and then from Fed rate hikes have been one of the clear winners in terms of how profitable their business models are. And then just one other thing to note, whenever we're kind of in a either low rate environment like you've seen over the past, I guess from 2008 to 2015, the expense section is one of the only levers a bank has to control their profitability. So they're looking to lean out, trim out all the fat from the business model that they can. So you actually, as the Fed paused recently, you've seen a handful more banks starting to talk about efficiency plans, or how are we going to manage expenses, or pointing to no expense growth. So that's become a bigger topic in the past probably 2 or 3 months. So the next way banks lose money is their loan loss provision. Did you guys? I think I saw this in the notes. You guys talked about that.
We covered it.
So it's kind of interesting because there's a current framework that banks follow, and then starting January 1 of 2020, there's a new framework to determine loan losses. Right now, if a bank has an indication that a loan is not going to pay off in its full value, so say I've got a $5 million loan, the borrower is going through financial hardship, I discount the cash flows that I think they can pay me at this point in time, it's $4 million. I have to take a $1 million charge off on my loan. So it's a $1 million charge off that comes through the loan loss provision line. Banks have an allowance account for loan losses. So your gross loan book, the dollar value of loans that you've got, minus your allowance account, is the net realizable value of your loan portfolio. Banks typically are reserved on their loan books around 1%. I would bring that up just because that's another thing when we're looking at a bank from just a really high level perspective. Kind of one of the first things we look at is, okay, one, how they perform in the past cycle. What does their credit look like right now? And then 3, how does their allowance look? Do they have like an appropriate level of allowance on their books at this point in time? Because basically, if you're over allowanced for your loans, you're not going to have to take this provision charge if you write down a loan. Just because when you mark it down, it's either going to come from that allowance because you've already marked it, or it'll come from loan loss provision. You immediately charge the loan off.
So if your allowance is large enough and you have a loan loss, it doesn't flow through your income statement. But if your allowance isn't large enough and your actual loss is higher than your allowance, then that's going to be added to, it's going to run through your income statement, and it's going to hurt your profitability. Is that what you're trying to say?
Yeah, that's correct. I don't know if I did a great job explaining that one, but I chose this bank as an example. It's pretty interesting. In the second quarter, they had kind of a credit problem where they had two borrowers who someone in the company committed fraud. The loans were completely charged off. They took a $9 million provision. And actually the bank in this example, because of that $9 million provision, the charge off they took, their multiple is still trading at a depressed value relative to their peer group, significantly depressed valuation, despite they're probably one of the most profitable banks, and this was just kind of a one-off thing. So it does really impact profitability. It can impact profitability. And I kind of ran a hypothetical here. So I guess by definition, banks are pretty highly levered, not in like the traditional context we're looking at debt to EBITDA, but because they have so many borrowings in the shape of deposits on their balance sheet, it's considered a liability. So much of that relative to their equity value, they're pretty highly levered. So in this example, you've got 11 billion of assets on your balance sheet. You have 1.4 billion dollars of equity. Again, this is from one of the banks that we look at. Out of that $11 billion asset book, you have $8.6 billion in loans. Just for an assumption's sake, say you're reserved at 1%. Your allowance is 1% of those, so 86 million. So then you've got your equity 1.4. In the bottom left corner, say a bank took a 10% charge off on its entire book. That's very drastic, but it did happen in the last crisis where you saw banks take charges this large. If you took a 10% loss on your entire loan book, it's $862 million. Your allowance obviously can't cover that. Whatever money you made that year, that quarter, is not going to cover that either. So it automatically gets taken out of equity. Your equity retained on your balance sheet is what goes to pay for that. So in this scenario, they went from having $1.5 billion in equity almost down to $670 million, which doesn't mean they failed, but it means they get pretty close to failing. They went below the regulatory capital thresholds. They don't have capital anymore. They have to raise TAR, or in 2008 they raised TAR. They have to raise equity. They need more capital on their balance sheet. So it can be pretty significant, which is why people key in on what type of lending that banks do.
In the prior example, you mentioned that they had a loan write-off, otherwise they're very profitable, and it impacted their multiple, and their multiple is trading at a depressed level relative to the comp group. So what that indicates is a heightened risk awareness among investors. And they don't know, you said, well, that's a one-off thing. The fact that the multiple is depressed means that investors don't feel good about that. And we talked about that with Bank of the Ozarks, where they had a $50 million loan write-off, and it cost them $500 million in market cap.
Right.
For the very same reason.
It cost them 40% of their capital.
Right.
The stock was down 30-something% of the day.
Right. Over a $50 million loan write-off, because all of a sudden all bets are off, like, okay, what's going to happen next?
Yeah. No, that's exactly accurate. This stock in particular, I showed it at a later point in time, but bank stocks trade at probably 10 times, 11 times price to earnings. This stock's trading at 7 times, 7.2 times 2020 earnings, which is very, very cheap, the return discount to the group. It wasn't that cheap immediately following this event, but as, I guess, at that point in time, people weren't as skeptical with credit. Whenever the economy sort of slowed down a little bit, there was China talks, I guess Fed stopped moving, the Fed thought the economy was in a good spot. People think we're at the top of the cycle now. So fast forward 6 months after 2Q18, that's when you saw the multiple compression kick in for this bank. It's when people started to get aware of credit. They started to key in on who has had issues in the past, who could have issues going forward. They automatically panic button. They might sell a stock like this.
Right. And if you're right, that this is a one-off thing, this is a buying opportunity.
Exactly. So that would signal if you have comfort that it's a one-off credit, which if you go back and you do the work, you dig into it, it is a one-off type credit. This is a very small book. This was, I guess, this type of lending was something legacy they acquired. It was $20 million total portfolio. That was $10 million of it right there. The other $10 million matures in a year and a half, so the chance of them taking another loss on that is very, very slim. So you would expect after they get rid of that book that the multiple moves back up. When the multiple moves back up, if you bought it at 7 times, it's at 10 times, you just outperform your peer group probably.
And we'll talk after class so I can get the name and I'll stop.
Yeah, I left all names out of the presentation. Yeah, touched on this. I guess one other point. While this example right here, at your ending equity piece, you still have $674 million of equity. If you flash back to 2008, that probably would not have been the case. Banks now hold more capital on the balance sheet. I know $1.4 billion in equity compared to $11 billion in assets doesn't seem like a lot of skin in the game, but compared to what banks used to have when they weren't as regulated, that's a decent amount of equity. So right now they're above their equity threshold or their minimal capital requirements the government sets for banks, but in this scenario where they took a charge, they would not be anymore. So I guess I broke out just a few different type of lending categories that we look at. How banks usually report is based on these few categories. There's 100 more specific types. These are kind of broad-based, and I think it's pertinent to kind of understand different aspects of lending, just given, like in the prior example, whenever people are so focused on credit, trends in credit quality, all of these loans have completely different characteristics, risk involved in the transaction. So one thing that investors have done recently, have been doing the work on, is really digging into the loan portfolio, seeing what a bank has, whether it's C&I, C&D loans, to figure out which one they think is more risky right now, which one could be more risky, it's more likely to default, to make a call on credit. I don't know, Alex, you may not want me to go through all of these.
No, I've got bankers coming in next week to talk about their loan products.
Yeah,
So
he's going to do a better job of explaining them to you.
okay, that's fine.
Just, I think the one that I would focus on here, commercial and industrial, and then C&D loans. Those are the two that I talk about. C&I loans, these have been loans that people have been keying on recently. So what a commercial industrial loan is, it's a loan to a business. So a business entity is borrowing money to finance their operations, to finance expansion. So these loans could be a revolver loan, like a cash line that a company can draw on to meet short-term funding needs. It can be a term loan where they're financing expansion. Most of these usually carry decent credit quality, but what people have been keying on recently is lending to highly leveraged companies. So HLTs, highly leveraged transactions, especially in the bigger context of loans, syndicated credits. This is an area people have been really focused on recently. Construction and development loans. So this is where a company, or not a company, this is where a person buys a lot, buys a piece of land, or even a building, and I guess the intent is to refurbish, change up a structure, or build a property on this land. It's usually considered riskier because you're just buying a piece of land. It can be valued off of what the land will be once you build the property. And this is what you saw back in 2007. So across public banks, this is where their losses came from in the last cycle, just broken out by the same portfolios we looked at just a minute ago. C&D loans, by far and away, drove the largest credit loss in the last cycle. That's why investors are also very focused on who has C&D exposure.
So it's one to four family, you're talking about apartments. Is that what that is?
One to four family real estate is going to be like your bread and butter mortgage. Like if I went and bought a house, 1 to 4 family real estate. I guess.
So are those builders primarily?
builders or home buyers. Mortgages in that category.
Yeah,
I think what you're thinking of would be in multifamily. So that would be an apartment complex. 1 to 4 family real estate.
Yeah,
Could be a duplex, or I don't know if you call them triplex or quadruplex. Anything less than four doors. Yeah, so by far and away, I guess to back up, whenever we first take a look at a bank, this is one of the first things you look at is the composition of their loan portfolio, because it varies bank by bank. Each bank has a different mix of loans on the balance sheet. You do the best job you can trying to get as in-depth of the loan portfolio. What I found out recently in this long project I did was not all banks get as granular as you would like with the lending they do. They all provide these categories right here. You can make an assumption based on what they've said in the past or what they've done in the past as far as their underwriting standards and how it can perform in the future. But I'd say the loan book and the composition of that is one thing to focus on. And I kind of make the same point here. This is a really interesting graph we put together recently. It only covers about 30 regional banks are included in this average, but it was the mix of loans they had on their books at 2007 at the year end versus what they had when they reported results in January on the books. You've seen a significant decline in construction and development loans since 2007. You've seen that because nobody wants to touch it, the 10-foot pole anymore, because of this right here. So a bank has heavy C&D exposure right now. People are a little more skeptical about it. Yeah, I guess the regional banks, if you're talking about like the 1 to 4 to get to like the point of mortgages, the subprime stuff, that was more of like the bigger banks that were buying those paper in 2008. So most of the regional banks aren't buying like subprime paper or buying 1 to 4 paper. They don't have collateralized debt obligations. So that's basically it on the income statement analysis. So this is kind of just to refresh everything, a clear picture of all the pieces together. You have your revenue, you have your operating expenses, your background expenses. It gets you to your income section where you can get to an EPS number. You can determine your profitability metrics for the bank. That's, I guess, alongside efficiency, we also look at ROA, return on average assets, ROTCE, it's return on tangible equity, 1.5% ROA and 21%. It's called ROTCE. It sounds kind of weird, but 21% ROTCE is one of the best in the industry. So this is the same bank from the example that had the credit loss earlier in the year. So despite that profitability, they're trading at a low valuation. So I guess moving over into valuation now, there's a few different ways we look at banks, and really your top two are the most prominent, with the price to earnings being definitely the most prominent. Price to tangible book value is something that everyone does pay attention to, but it's not as widely used. Core deposit premium, backing up to my discussion about how many deposits a bank has on its balance sheet relative to overall funding. This is a measure that if someone's looking at, they want someone with the best, the best liabilities, the best deposits on their balance sheet. Core deposits kind of measure that. So if someone's looking at banks based on that, they would use core deposit premium valuation. It's also used in M&A a lot to determine like the price of the transaction. Dividend discount model, that was included in this presentation. I've never used a dividend discount model for a bank. A handful of mid-cap banks are growing well enough right now. They don't have to return capital via dividends. All organic. They use capital for organic means. Takeout value method. This is a big one as well. We use this particularly if we think a bank is going to sell. And I'll touch on M&A here in just a little bit, but just to start on price to earnings. So starting in the bottom left, you can kind of see how banks have traded historically. Right now, we're at relatively low valuations. This time last year, valuations were not this low. I talked recently, or just a minute ago, about people were starting to get concerned about credit, concerned about what's the tailwind. The Fed's done raising rates. We've got tax reform, which benefited banks greatly. There's been stress in the equity markets recently, kind of in December in the bank market, and then this quarter some as well. So you've seen multiples compress a little bit at this point in time, about 2 turns of multiple compression across banks. Banks typically trade at a slight discount to the actual S&P 500. It's not much, 91%, but right now banks are at 68%. So if you're bullish on the outlook for banks, it's a great time to buy relative to wherever else you can buy in the market. I guess price to earnings multiple, just to talk about it a little bit, it's definitely the most common metric that we use. It was not used, you can see I've barred out in the graph here where the multiple went during the downturn. That's because it was sky high. Banks weren't earning any money because they were charging off all their loans. So outside of a non-normal environment, people look at the price to earnings multiple. So that's kind of where our job gets interesting, is what we do. A big part of what we do is we forecast out earnings for all the companies that we cover. So for each of the banks that we cover, my team covers 29 banks, I think. Yeah, 29 banks. For each of those, we have an earnings model. Max is pretty familiar with an earnings model. There's probably 400 different rows in there, thousands of different variables and inputs that could drive this model. Everyone on the street runs the same thing. The point you're trying to get to is you're trying to have the most accurate earnings number in the future. That means that your current multiple is correct because the price is static. Everyone's using the same price. You want the most clean, the best earnings number, the most accurate earnings number relative to the street. And that's where it gets interesting, is especially the bank. I can use this bank that we've been talking about pretty much every example. I wish I could give you the name of it. There's a huge discrepancy in street numbers. They're closing a deal soon, so there's a lot of noise. But I think that we're doing a better job in the street in modeling it out. I think we talk to management a lot. We know, I think, where their head's at. We know what they've said in the past on calls and everything. And we have a good feel for the bank. So we think our earnings number is correct, which would suggest the stock is cheaper than it actually is on streets numbers. So that becomes interesting. Whenever you have a discrepancy in earnings versus the street, there's a discrepancy in the multiple. There's either buying opportunity or selling opportunity. So that's kind of in our job. Whenever we realize that, that's kind of when you pitch a stock. So we talk to institutional investors on a daily basis, hourly basis. Investors call in from hedge funds, long-only shops, and they want to know what we think about a company or what we think about the group, what stocks are we pitching right now. So in a scenario where my earnings number is significantly above the streets and I have confidence in my earnings number, that would be the stock that I would pitch long in that scenario. Yeah, and I guess typical factors influence price to earnings. So your earnings number